Welcome. My name is Gina Morais. I'm a financial advisor with Summit Financial Group, and I'm going to be walking you through my first quarterly market update for 2026. Thank you for taking the time to join me. I appreciate it. Welcome to our 10 themes for 2026 webinar. Our theme this year is Mission Impossible, which is celebrating its 30th anniversary of the first movie in the franchise. We chose that theme because 2025 was extraordinary for investors. It might have been almost impossible, although not. Every major asset class delivered standout performance. Emerging and developed markets surged more than 25%. The S&P 500 climbed about 18%. Commodities soared on record gold and silver prices, and even fixed income posted gains of more than 5%. But after a year like that, valuations have soared. The S&P 500 price to earnings ratio now sits in the 95th percentile over the past 2 decades. Bond spreads are the tightest since 1998, and commodities like gold and silver are trading well above their fundamentals. However, despite these elevated valuations, investors seem comfortable, maybe too comfortable. Consumer confidence surveys show nearly half of respondents believe stock will be higher in 12 months. History tells us that when everyone starts thinking the same, markets often move in the opposite direction, at least temporarily. But we didn't pick Mission Impossible because we think success in 2026 will be impossible. We believe success is very possible with the right strategy. The road ahead may be more challenging and returns more moderate, but staying agile and focused on fundamentals, investors can still achieve positive outcomes. Here are the 10 themes for 2026. They're going to range from talking about everything from our economy to the bond market to the different aspects of the equity market. And then we're going to finish up by talking through asset allocation. Our first theme here, the United States economy. The economy has been a lot like super agent Ethan Hunt from Mission Impossible, defying the odds and pulling off what seems impossible with grit and ingenuity. Over time, the US economy has shown resilience, resourcefulness, adaptability, innovation, and determination. It recovered after crises like the dot-com bubble, the Great Financial Crisis, global shocks like the Eurozone debt crisis, and the COVID pandemic. Every time the system is tested, it adapts, rebuilds, and emerges stronger. Now, will we have another recession? Yes, recessions are an inevitable part of the market cycle, but history teaches us something powerful. Every single time the US economy faces an obstacle, it overcomes it. Looking ahead to 2026, we expect the US economy to pick up speed, posting GDP growth of about 2.2%, a modest improvement from 2.0% in 2025. 5 key forces are propelling this acceleration. Now, what's behind this stellar acceleration? First, the One Big Beautiful Bill Act. This legislation expected to put more money back into people's pockets. No tax on tips, no tax on overtime, and an increase in the SALT deductions. Because these changes were retroactive to the start of last year, we're looking at surprisingly large tax refunds. We estimate households could receive up to $1,000 more on average compared to 2025. Second, those refunds will be even bigger for the top 10% of households. The CBO estimates they could increase by $14,700 per household. And that matters because that top 10% drive nearly half of all US consumer spending. Combine that with strong market performance, and you've got a powerful tailwind for consumption in 2026. Third, stronger business spending. Tax incentives like accelerated depreciation and the ongoing AI build-out are fueling investment. The chart on the right shows 5 mega-cap tech companies alone are expected to invest around $600 billion in capital expenditures, more than a 30% increase from last year. Fourth, foreign direct investment. The US is projected to attract nearly 10 trillion over the next decade, about 1 trillion per year, across energy, manufacturing, technology, autos, and more. Now, 10 trillion is an estimate, but even if just 25% of that comes through, that's 250 billion annually, which could add 0.8% to GDP each year. And finally, there are intangibles. America's co-hosting the World Cup, my favorite sport. We're celebrating our 250th anniversary and preparing for midterm elections. With the global spotlight on the US, it's hard to imagine policymakers doing anything that would weaken the economy. These factors create a strong backdrop for growth in 2026. Our second theme is going to be monetary policy. In the Mission Impossible universe, the Impossible Mission Force works to build the scenes to stabilize global crisis. In the financial world, that role belongs to the Federal Reserve. The Fed's dual mandate focuses on inflation and jobs. Now, let's start with inflation. It's likely to stay stubbornly above the Fed's 2% target for most of 2026, but two positive shifts are on the horizon. First, the price impacts from tariffs should fade. Second, and more important, the components of inflation not tied to tariffs, like shelter and other services, like healthcare and transportation, which make up 2/3 of inflation, should start to moderate. That means the Fed's primary focus will shift to employment, and the labor market is losing momentum. Job growth in 2025 was one of the weakest years outside of a recession, slowing from over 6 million jobs just in 2022 to under 700,000 in 2025. Wage growth has cooled across all income levels, with the sharpest slowdown among lower income workers. At this pace, wages for the lowest earners could soon fall behind inflation, eroding real purchasing power. Layoffs are rising too, over 1.2 million last year, on par with the great financial crisis. The unemployment rate has already ticked up from 4.1% to 4.6%. When we consider all this data together, the labor market is clearly softening, and the pressure is greatest on lower income households. Here's where the plot thickens. In 2026, a new leader takes charge at the Fed as Jerome Powell's term expires. The incoming chair faces high-stakes assignment, steering policy through uncertainty while balancing data and political pressures. Whoever gets the role, one thing remains key: the Fed's independence. And we believe the Fed will remain independent regardless of who is chair. The Fed chair is just one vote among 12. So leadership is really about building consensus, not acting alone. The Federal Reserve also draws on significant expertise, supported by over 1,000 economists nationwide, whose research informs policy decisions. Board members serve 14-year staggered terms, making it very difficult for any single president to appoint a majority. Now, this structure is intentionally designed to ensure independence, similar to the Supreme Court. In fact, the Supreme Court has affirmed that a president cannot remove a Fed official without cause. That independence is critical to credibility. If the Fed's credibility were questioned, interest rates could rise, undermining economic growth and complicating the financing of the national debt. We expect the Fed will stay data dependent, focused on what's best for the economy, not politics. Under that framework, we expect at least one rate cut in 2026, taking the upper bound of the Fed funds rate to 3.5%. Our third theme is going to be volatility returns. For most of 2025, markets were surprisingly calm outside of a few big moments. It was a remarkably steady backdrop given all the uncertainty swirling around. In 2025, the S&P 500 had just two 5% or more pullbacks. Normally, we see four. We had one major drop of nearly 20%, but then one of nearly the fastest rebounds in history, only 56 trading days. All 11 sectors finished in positive territory for the year, and the gap between the best and the worst performers was unusually narrow, the lowest since 2018. Bond yields stayed in the tightest range since 2018, and the Bloomberg aggregate posted its strongest performance since 2020. Every major fixed income sector ended the year in positive territory. But several potential plot twists could bring volatility back in 2026, ranging from the economy to geopolitical risks. For example, if the Fed cuts rates more than expected and the economy runs hotter, inflation could spike and rates could rise. In equities, multiple private companies, especially in AI, are expected to go public, but a disappointing IPO could shake confidence in tech valuations. In bonds, if markets sense Fed independence is at risk, confidence could erode and rates could soar. Geopolitical tensions could ripple through commodity prices. Now, what we're saying today is that not all of these risks are going to materialize, but if we ignore them, it's dangerous. The key to this is being aware and agile. We need to be ready to adjust if any of these catalysts should hit. Our fourth theme is going to be the bond market's role in mitigating portfolio risk, a sort of safe house where investors can regroup if the mission goes wrong. Let's take a look at the major stress periods in recent history. If you look back to the dot-com bubble, the equity market fell 44%. The great financial crisis fell 57%. And in COVID, we fell 34%. But if you look at the light blue bars, you will see that the bond market was actually positive, and that's stability. During the great financial crisis, COVID, and the European debt crisis, even the yen carry trade unwind in 2024, bonds held their ground and stayed positive in the face of sometimes dramatic declines in the equity market. That stability matters. Let's talk about interest rates and Fed policy because it's important to recognize that the Fed has moved away from so-called non-traditional monetary policy. This means it is no longer actively engaging in quantitative easing, buying bonds to expand its balance sheet, or quantitative tightening, shrinking the balance sheet by not reinvesting maturing bonds. When the Fed was purchasing bonds, it helped push interest rates lower. More recently, as the balance sheet has been reduced, interest rates have risen. As of December 1st, the Fed has indicated it will no longer rely on those tools. Going forward, fundamentals, not balance sheet policy, will drive interest rates. We expect a return to a pre-GFC environment where rates generally trade in a 4 to 5% range. Based on a gradually improving economy, one Fed rate cut, healthy demand for treasuries, and moderate job growth, we expect the 10-year treasury yield to end the year between 4.25% and 4.5%. For yields to fall meaningfully below 4%, we would likely need a recession or a sharp deterioration in employment. And for yields to rise above 5%, we would need sustained economic growth above 3% or a significant decline in global demand for US Treasuries, neither of which is part of our base case. We expect the yield curve to continue modest steepening in 2026. Short-term yields like the 2-year should stay anchored as the Fed likely cuts rates once more to support the labor market, while long-term yields drift slightly higher on better economic conditions and heavy Treasury issuance. But don't expect runaway yields to the high side. Demand remains strong. Foreign holdings of Treasuries just hit an all-time high of $9.2 trillion, and bid-to-cover ratios show a healthy appetite for US debt. One important long-term dynamic for bonds is their income generation. Historically, income accounts for the vast majority of bond returns, shown by the dark blue bars in the left-hand chart, with only minor capital appreciation or depreciation over decades, shown by the light blue shading. With rates expected to stay relatively stable, bondholders should earn near current yields over the upcoming year, which means high-quality bonds returning to around 4 or 5%. We favor high-quality exposure, investment-grade bonds, and municipals, where yields remain above long-term averages. High-yield bonds are right on their historical average, so we don't believe investors are being compensated for the extra risk inside of those bonds. The bottom line here is bonds are due back to doing what they do best, providing stability and income for you. Our fifth theme is going to be the identity shift in the US equity market. The magnitude of returns has changed, as well as the drivers behind those returns. 2025 was quite a year. Despite a 19% peak to trough drop in the spring from tariff fears, the S&P 500 still finished last year up 18%. That's the sixth time in 7 years we've seen annual returns above 15%. A streak we've never seen before going back to the 1930s. However, going forward, we expect more moderate but still positive performance. Let's examine why. When looking at our equity dossier, a deep dive into the data that shapes our outlook, here's what we see. No recession on the horizon means revenue growth, margins, and earnings should stay above average. Therefore, the underlying fundamentals of the equity market remain healthy. The Fed cutting rates in a non-recessionary environment would be a tailwind. It keeps the economy humming, and lower short-term rates make equities more attractive. Let me go back one slide. There we go. History is also on our side. The fourth year of a bull market tends to deliver moderate gains. Looking at past political trends, midterm election years bring volatility, but they usually end up positive. Now, this all sounds like positive news, but we still advise caution, and here's why. Valuations are in the 95th percentile. And while they are expensive, much of it is warranted as companies are so much more profitable than they have been historically. And higher profit margins are usually consistent with higher valuations. The middle chart shows that over time, there's been a strong positive correlation between profit margins and valuations. Higher profit margins support a higher price to earnings multiple, and that makes sense as more profitability leads to more cash flow and potential for investment. Margins near 14% justify current valuations. So we expect only a slight moderation in price to earnings from 25 times to 24 times. Don't expect multiple expansion to drive returns. Earnings growth will have to do the heavy lifting this year. Also, positioning is stretched. The US households hold a record 45% of their financial assets in equities. That limits further upside from new buyers. Our models show earnings growth of 10 to 12% for the S&P 500, supporting our forecast of $300 EPS for 2026, with AI and tech leading the charge. Assuming a 24 price to earnings ratio, which is close to where it is today, gets us to our target of 72.50. This base case is predicated on the economy remaining on solid footing and disinflation continuing, but only enough for the Fed to cut one time. However, if tariffs were to lead material reacceleration in inflation, leading to a hawkish policy response and challenging profitability, or if the economy weakens materially, that would lead to our bear case of 6,200 with $285 in earnings per share. Alternatively, if the economy accelerates more than we expect while disinflation allows the Fed to remain dovish, That would lead to our bull case of 8,200 for the S&P 500. Our forecast has a slight bias to upside risk rather than downside. Now, on to our sector themes. Tech is still a favorite despite many investors becoming nervous around artificial intelligence. The first concern, valuations. People worry tech is getting pricey. But if you look at the price to earnings ratio of the tech sector from January to December, they've actually moved lower. And versus 5 years ago, they have not changed. That's because earnings growth of about 27% in 2025 and 28% forecasted in 2026 is doing the heavy lifting, not multiple expansion. Comparisons to tech valuations during the dot-com bubble show we are about 1/3 of those peak levels. This isn't the same thing. The second major concern is rising capital investment and leverage. It's true that some firms are spending more and taking on debt, but perspective is important here. Tech's capital investment as a percentage of sales sits right in the middle of the 11 sectors. And as far as debt, tech still has the lowest leverage of any sector. Another risk we're watching is policy. Some state and local governments are pushing back on new data centers due to power costs. That could become a major talking point in midterm elections. But the president continues to champion the United States leadership in AI. And even if data centers need to relocate, there are plenty of regions that would welcome that investment. The bottom line here is that these risks are headline risks, not fundamental game changers. Now, we are bullish on tech and AI because the earnings justify the optimism. But going forward, we need to be more selective and strategic. So here's a new code word to unlock success in tech this year that we're going to be using. The C stands for chips, the foundation of AI. Computer power drives progress. Semiconductors were a $500 billion industry in 2023. And by 2030, they're expected to hit 1 trillion. The I stands for industrials. Scaling AI means building data centers and lots of them. Construction has jumped from 13 billion in 2023 to over 40 billion in 2025. That's nearly 4 times growth in 2 years. The P is for productivity. Why all this investment? Because AI boosts productivity, just like the internet did. We expect the S&P 500 net margins to stay well above 13% for the long-term average. The H is for hyperscalers. The big tech players are driving this build-out. Hyperscaler CapEx is projected to surpass 500 billion by 2026. The E is for encryption. AI brings opportunity, but also risk. Cybersecurity demand will soar as global cybercrime costs are expected to hit 14 trillion by 2028. And the R is for robotics, the next frontier, bringing AI into the physical economy. Think Amazon's warehouse robots and Tesla's autonomous vehicles. Both are reshaping consumer sectors. Cypher is not just a code word or acronym, it's a roadmap for investing in the AI-driven future. Our next theme focuses on 2 sectors that have been hiding in the shadows, 2 overlooked underperformers, but like in spy movies, sometimes your best allies are the ones you least expect. Our 2 contrarian picks are consumer discretionary and healthcare. Consumer discretionary could see a surprise comeback, and here's why. This sector has been pricing in a lot of bad news, tariff risks, fears that consumers are tapped out, and headlines screaming about slowing spending. But the reality actually looks much brighter. Job growth is estimated to bounce back from 2025. The wealth effect from rallying financial markets and real estate should bolster spending. Tax refunds and lower deductions will give consumers a one-time cash boost and ongoing relief. And spending momentum is rising, despite what the headlines say. Banks report credit card delinquencies are declining for the first time since 2020, signaling a healthy consumer. When you add in attractive valuations and even a little tech exposure, think robotics, and you've got a compelling setup for 2026. The bottom line is a strong consumer plus reasonable valuations, excluding the tech-related names like Amazon and Tesla, and the fact that this sector is trading at a discount to the S&P 500 equals a positive risk-reward story. Healthcare is an underdog with an upside. In 2025, healthcare underperformed for the third straight year on the back of negative Washington policy rhetoric, something we haven't seen since 1990. In fact, healthcare has never underperformed for 4 consecutive years, but it has also been an underperformer in 6 out of the last 7 years. Now, here's why we seem to want to look at it this year. During the year, the sector traded at nearly a 30% discount to the index, historically low, which makes it the most attractive sector from a valuation perspective. Even after the fourth quarter rally, valuations remain near -1 standard deviation below the historical average. Policy headlines can swing sentiment fast, creating opportunities for patient investors. And using history as a guide, the bark of Washington, D.C. is often worse than its bite when it comes to policy implementation. This is one of the few areas where valuations alone make a strong case, but we think this policy-driven underperformance is a buying opportunity, and recent rallies prove how quickly sentiment can change. Now let's go ahead and walk through our theme number 8. This is going to be the power shift from oil to electricity and how to spot double agents in the changing energy markets. For example, as companies race to build more data centers, power demand is skyrocketing. Now here's an interesting statistic. Every single AI query uses enough electricity to run a microwave for about 1 second. Now watch TV for a few seconds or keep a light bulb on for 10 seconds. Sounds tiny, but when you multiply that by billions of prompts every single day, the total energy demand is massive. And if you're generating images or videos with AI, that uses even more power. When you think about who benefits, the obvious answer might seem like the utilities sector. But here's a catch. Utilities require huge capital investments, and their rates are regulated, so they may not be able to quickly increase their prices. So utilities is not necessarily the best play, especially since its valuations have gotten more expensive. We prefer the industrial sector, the real picks and shovels behind the AI build-out. These companies are seeing explosive demand for electrical and power generation equipment for data centers. Gas turbines, solar panels, batteries, transmission lines for the grid are made by industrial companies, with industrial investors also get exposure to other growth like secular drivers, and consider replenishing and expanding global defense stockpiles. In most cases, there's a major gap between 2025 defense spending percentages and the new target NATO has established. These themes are well insulated from macro shocks, form a key part of our 2026 sector investment thesis. Now, when it comes to commodities, there's one thing we need to talk about: energy. We're still underweight because supply growth is expected to run about twice as fast as demand growth, again in 2026. With oil likely stuck in the $55 to $60 range, energy stocks could deliver subpar performance again in the near term. Rare earth minerals are getting a lot of attention. These are critical components in everything from smartphones to MRIs to electric cars, and now they're being considered vital to national security. However, there's zero exposure to rare earth metals in the S&P 500 and limited exposure in small caps, and it's expensive. While rare earths may be a hot topic, they're not a practical play for most investors right now. Now, turning to theme number 9, international markets. International markets were in the spotlight in 2025, and for good reason. The EFA index outperformed the United States by the widest margin in United States terms since 1993. But looking ahead, the key question is this the start of a durable trend for international, like the one that persisted in the early 2000s, or is it just another flash in the pan? When it comes to developed markets, we're still in favor of the United States, and here's why. First, the currency tailwinds that boosted international markets last year have faded as the dollar stabilized. With the dollar likely to hold steady in 2026, those gains won't repeat. Second, the US should benefit from a more market-friendly policy mix. Another Fed rate cut and upcoming fiscal stimulus should support United States equities. Compare that with Europe, which is likely done with its rate cuts, and Japan, which just raised rates to a 3-decade high. Third, fundamentals favor the United States. When it comes to growth, the United States economy is expected to once again outpace Europe and Japan, despite Europe's fiscal spending initiatives and Japan's pro-growth policies. While earnings are improving across most major markets this year, the US is still expected to post the best earnings growth in 2026. And finally, sector leadership really matters. As you can see on the chart on the right, the US has the highest weightings to sectors that are driving the best earnings growth and upside potential, with nearly 70% of the index allocated to the sectors we like in the United States. When it comes to the emerging markets, we still find emerging markets attractive relative to DMs, with our preferred region being emerging markets Asia. However, selectivity across markets and sectors is a key thing to consider. When emerging markets Asia doesn't have the multi-trillion-dollar tech giants like the US, the AI boom has made tech a growing part of the index. Countries like China, South Korea, and Taiwan are home to some of the leading players. In fact, 7 of the top 17 tech companies reside in Asia versus only 1 in Europe. As a result, tech's share of EM has risen from 18% in 2015 to around 27% today. And that's important as tech remains one of our preferred sectors. Plus, EM Infotech is attractively priced, trading at a significant discount to US tech names. Now, one area of focus in Asia is India. While India lagged considerably in 2025, posting its weakest annual performance versus EM in over 3 decades, we remained constructive for these reasons. India has the fastest GDP growth among the G20 countries, with growth in excess of 6%. Favorable demographics, with India, the world's most populous nation, creating a strong foundation for long-term consumption growth. Friendshoring benefits as global supply chains continue to diversify. And then rising foreign investment. Some of the major tech giants like Amazon, Microsoft, and Google have announced over 67.5 billion in planned investments to tap into India's digital infrastructure. Finally, after subpar earnings growth in 2025, India's earnings growth is expected to reaccelerate and outpace the ACWI index in 2026. Our last theme is asset allocation, being positioned for success in this next mission and into the future. Now let's take a look at this chart. The S&P 500 hit nearly 40 record highs last year alone, but those highs came with plenty of bumps along the way. Since 2000, we've seen 23 pullbacks of 10% or more and 5 bear market drops of 20% or more, often tied to the 3 recessions we have had. Yet over the past 25 years, the S&P 500 is up about 660%, an average of 8% per year. Now you may be thinking, why should I invest when the market is at a record high? Here's the surprising truth. If you invested on those record high days versus any other day, your returns were just as good, if not better. Time in the market is more important than trying to time the market. And that is a reminder that successful investing relies on consistency, discipline, and a long term plan. And the secret is simple: stay in the game. Think about Tom Cruise, who plays Ethan Hunt. He finally won his first Oscar last year in November, and not for one film, but for a Lifetime Achievement Award, celebrating 4 decades of acting, producing, and redefining modern cinema. His success wasn't built on a single blockbuster, it was built on a body of work. Investing works the same ways. Portfolios grow through a long term strategy, staying invested through the twists and turns, contributing regularly, reinvesting, letting compounding do its magic, and staying diversified. Diversification matters because each asset class, stocks, bonds, and cash, play a unique role in your portfolio, just like Cruz's diverse skills shaped his career. Asset allocation is your blueprint for navigating the market's inevitable plot twists. Our ultimate mission is to build a portfolio that is diversified, that can maximize your chances of achieving your long-term goals and mirroring your plan. Thank you for taking the time to tune in to my first quarter market update. If you have any questions, please feel free to reach out via email or phone. I look forward to seeing you all for my second quarterly update in April.